Welcome to the Business of Property podcast. I'm Simon.
I'm Stuart.
We're both property people running our own businesses. This podcast is just us chatting, as we often do, about anything and everything property. We're going to start this week by mentioning that we've been chatting to someone else about property. And this person was kind enough to then write about our conversations. Stuart, would you like to elaborate a little bit more on what I'm hinting at here?
Yes, well, we finally made it to the big time, didn't we, Simon? We made it into the Times, the national newspaper, not our local version, but the Times. And we are in the bricks and mortar section, which printed a couple of weeks ago now, but still online, all around the key question for a lot of people, which is, should I invest in a buy-to-let property in 2022? And both Simon and myself had a conversation with the writer of the article, Carol Lewis, and she's put quite a lot of our views in there. So if anyone didn't see that in the printed paper, you can still go online and view it. It is behind a paywall, but there is I believe it's a 30-day free trial period, which I have used myself. And yeah, we're still there, and we'll put a link into the show notes so that people can go and see that. But more than it just being about us, it does actually raise some interesting points around buy-to-let, and particularly it talks about some of the best performing rental spots for yield, Simon, which is a table which is on the article, both online and offline.
Yeah, they picked up just I think it's top 10 or so actually in the printed paper. But the source for that you actually went and found, and we'll include a link to that as well in the show notes. And it's from Track Capital. They've put together a yield map of the UK, maybe just England, not sure, but somewhere around that. And I should probably actually just quickly mention that while this is a static map that they've made for a period of time, PATMA does actually have a live yield map that you can go in and explore and scroll around and zoom in and out of for different areas to find out sort of the current yields that you might be able to expect based on real property listings and rental figures that are available at the moment. But anyway, small advert aside, looking through this table, the bigger table, you managed to spot, Stuart, that Redhill is listed, although it's actually listed as RH13, which is a Redhill postcode, but it's not quite Redhill, is it?
No, well, RH13 is Horsham, but Redhill as a sector was in there as well for the bottom. But that was in the bottom 25 areas, I believe. And you're right. It is it's the UK, so it covers Wales and Scotland as well. And just key ones to pull out for those listening was Nottingham, Bradford, and Manchester coming up the top. And it should be mentioned that these are postcodes. It's based on postcodes, but interesting that Nottingham and Bradford are coming up top. In fact, 2 Nottingham postcodes coming at top. But as Simon said, in the worst 25 postcodes by yield, unsurprisingly coming in the south, and the worst performing, the highest worst performing, if that makes sense, was Guildford. But then as we look through it, actually, yes, it is Redhill coming up as RH13, but that's coming up as a Horsham postcode. But interesting that Redhill, given that Simon and I both come from there, was on the list.
And of course, I'm looking to invest in Redhill at the moment as well. And their estimated yield for RH13, which, as we said, is not actually quite Redhill, is 2.5%. And I certainly hope to get a bit better than that investing in actual Redhill, or maybe just surrounding areas of Redhill. But yes, I hope I managed to do a bit better than their yield estimate for the Horsham area.
Yeah, and as always, this would be based on the averages for the area, and it's interesting just on the properties that you have looked at. And I know you don't specifically look at yield as a first metric to entry, but of the properties you've looked at, what sort of yields were they coming out at?
They're fairly wide ranging. So I would say 3% up to sort of 6% might be the top end of the yield that you might see. So fairly wide ranging. And then depending on how much refurbishment work you need to do for that before it's rentable, obviously then varies the ROI, because you can have a much cheaper property, and hence the yield calculation will come up quite high but you might need a much higher spend on the refurbishment, which would reduce your ROI. So yeah, the yields can be quite wide ranging. But I don't think I've really been looking at anything as low as 2.5%. Although, having said that, that might just be because those considerations would include much larger properties and things like that, which I just don't look at all for investment purposes.
Yeah, and also just looking at yield is, as we know from our conversations, for me, it's just a first sort of rule of thumb about whether or not I'm interested in a property. However, there are so many other factors that we would consider in terms of cash flow, capital appreciation, and so on, that the yield isn't the be all and end all. But it is quite interesting to see, in the list, and Guildford clearly not the place to invest if you're looking for a straightforward investment, because it appears there's quite a few postcodes of Guildford that appear in there, which is no surprise given where it is, and it's fairly local to us where we are. And of course, London will appear several times, and Hemel Hempstead, although I'm not sure who's looking to invest in Hemel Hempstead. Doubt they're listening to this podcast. Probably got other things to listen to.
Yeah, so the worst yield in Guildford is 1.9%. They reckon for this. So that's fairly low, especially when you consider the best yield from this chart in Nottingham, NG7 specifically, is 11.3%. So it's a big range from best to worst.
Yeah, and I'm not sure because I haven't looked at the details behind this or whether or not they're available in terms of where it comes from. But of course, given postcodes like Nottingham and Bradford, Manchester, depending on proximity to universities or places of work, will obviously change that yield if they're houses of multiple occupation. So it's something that needs to be considered as well, because my view on these sort of tables is usually that they're looking at what I would consider a sort of vanilla buy-to-let strategy, and just gives you a good indication of that.
Yeah, it's a little bit hard to tell from what they've listed as average asking rent per month. So looking at these numbers, my guess would be that in most areas this is vanilla buy-to-let. And all they've done is taken the average asking rent and the average asking price for sales and divided one by the other as appropriate to create your yield. And that's where they've got the yield figure from. So yeah, it's really all about working out the average asking rent and the average asking price, feeding into that calculation as to how real these yields actually are.
Yeah.
It's always interesting to have a look, even if they're not super accurate.
Yeah, I mean, looking at it, actually, I would think that Nottingham and a couple of the ones below, including Yorkshire, are possibly based on HMO properties based on that asking rent, because it's surpasses what I would expect in the south of London for a couple. So I think that that those numbers are coming in. So where they're getting that asking from, we don't know, but it seems like they're taking it off.
I'm not convinced. I mean, maybe they're varying it by area, but that would seem a bit messy. Because looking at the Redhill figure, their average asking rent listed is 965, and this is obviously not actually Redhill; it's Horsham. But Horsham is actually, I would expect, to be a slightly more expensive area than Redhill, and that rent is definitely not a multiple occupation rent. That's a sort of average, probably 2-bed type rental situation. So yeah, I wonder if perhaps it's looking at or distorted by different kinds of properties in the sales market versus the rental market in these areas. So, for example, perhaps in RH13, there are a few blocks of flats which are heavily rented, and that's skewing the rental figure down, whereas most of the sales take place for bigger houses which are nearby these flats or something, but in another street or so away, but still in the same postcode area, and hence pulling the figures around in a slightly distorted way. Anyway,
yeah,
we don't really know, so we probably shouldn't spend the entire podcast analysing figures in a table that we didn't create and we don't know the background of.
But the bottom line is, we made it into the Times. We're in the big time now, so please do leave us a rating or review. Just by way of, just consider it like a social mention, just to give this podcast a rating or a review, just to help us further get the message out there. And the message is that, we want to just share more information and help other people make better informed decisions when it comes to investing in property. On which note, Simon, we were also talking about pre-podcast the looming tax deadline.
Tax deadline? I don't know what you're talking about. What's that?
Well, it's something you've mentioned because it's something I tend to hand over to my accountant, and then he mentions it to me on a daily basis.
Yep. So, just for anyone who doesn't know, if you're a property investor and therefore a landlord, you almost certainly, there are some small edge cases, but you almost certainly need to register for self-assessment. And this means you have to fill in a tax return every year. At the end of the tax year, which happens at the beginning of April, from that point through to the 31st of January is your sort of window for completion of your tax return for the previous tax year. And of course, we are approaching the end of January, so we are approaching that deadline. This particular year, HMRC have decided to be a little bit lenient on charging fees for late filing and late payment. If you miss the end of January, you can go into February, and HMRC have said they'll be a bit lenient. I'm not entirely sure on whether they're going to drop all fees and all interest and things, or just the worst bits. But yeah, basically, end of January, you need to get your tax return in. And hence, I have spent this last weekend doing my tax return because, for some strange reason, I do my own tax return. It's something that I've done for probably 20 years or so, because I've been self-employed for a long time prior to... Actually, no, probably not prior to being a property investor. Maybe actually the property was the thing that started me doing self-assessments. Well, it might have come that way around, thinking about it. But anyway, I've been doing self-assessments for a long, long time. And every year, I collect together my figures. I work out the details that I need to provide. I reread lots of information about individual fields in the self-assessment tax return to try and remind myself what on earth they're talking about. And I fill in the figures. But you do this rather differently, don't you, Stuart?
I do. And you've touched on it a little bit there in terms of you doing your own and what happened. But why do you continue to do it yourself? Is it because you know what to do and it's simple?
I think mostly I'm a control freak. If I hand this over to anyone else, I would worry that there's going to be a detail missed. And I don't necessarily mean that the person I hand it over to will miss a detail or get something wrong. I mean that the whole process. So obviously they need to know the information from me at some point. So I would need to provide all that information, and then they would need to do their work to it and put it all together in an appropriate way and pass it to HMRC. But as I look through the tax return, I see a different section, and you sort of read through and say, yes, I've got property, and yes, I've got a limited company, and yes, I've got a sole tradership or dividends or whatever. And then you think, oh, and gift aid. Oh, yes, I have made some charitable gifts, so I do need to claim gift aid as well. But perhaps I would have forgotten to do that if there was an interface with an accountant sort of going on there. I don't know. Maybe accountants are very good at being super thorough at asking for everything. But that, I think, perhaps is a question for you, Stuart, because you do go through that experience.
Well, what's really interesting is we both do different things for the same reason. The reason I use an accountant is because I don't want to miss anything. And particularly when I look at the forms, I just look at them and it's just like watching a million numbers on a sheet. And my concern is that I miss a box or I don't tick a box I should tick. And then that leads me into problems. So it's quite interesting that we both have that desire and have come to different ways of dealing with it. And I suppose that's life, isn't it? In terms of in terms of how we approach things. And I think I started using an accountant. So it would have been, so we were the typical accidental landlords, my wife and I. And what became apparent was that obviously my wife had lived in the property, and then we moved out of the property. And for a couple of years, we rented it as, part of our, well, just as a flat that she'd moved out of. And what became clear was that we needed to be more overt about the rent and everything coming through. And to kick that process off, I wanted to speak with an accountant, because what I didn't want to do was for in a few years, following that, the tax man would come after me. So I just wanted to lay everything on the table and just say, right, this is where we're at. How do we make sure that we are covered and we're doing everything as we legally should? So I kind of sought that advice. And I suppose once our accountant had done that for us, it just felt easier to give the work to the accountants. But what was interesting, when we were talking pre-record and you were talking about what we needed to hand to the accountant, it did make me realise, well, I do fill in spreadsheets. So to be clear, so obviously we have properties in personal names, as in both my wife and I. Then we have properties in a limited company, then a consultancy business, and then a company that wraps around all of those things. So there are some technicalities and how we share losses from one business to another business, all obviously as it should be done. But when it comes to just the personal properties, actually every year I just go into a spreadsheet and I have to go through all of my invoices and receipts, and I just put those in the spreadsheet. But for the for the limited company, the bookkeeping was something I employed somebody else to do outside of the accountants, and anything that was spent or used would go through our software management system. We use Xero. You can use GetAgent or any others. And, so that's how we did it. So that's kind of what I do. And I suppose my fear is that if I step back away from that, so I'm going to start doing my bookkeeping now. But my fear is if I step away now, then again, I'll run the risk of omitting something I should actually include.
Yeah, I feel I should clarify a little bit on my situation. So I currently don't have any properties held in a limited company, but I do have a limited company. In fact, I have a couple. I have one that I part own that I used to do consultancy with, and I have another one which is creating PATMA and maybe a couple of things, but its main focus is PATMA. And for the limited company, I don't try to do those accounts myself. I do employ an accountant, and they put those details together. They track them in one of the popular general accountancy software tools, and they handle those processes as a CT 600, I think, which is the corporation tax return that has to be done every year, and that is significantly more confusing, I think is the word I would use, than self-assessment tax. And self-assessment tax it makes very little sense in many places, but the corporation tax makes even less sense. So that is something I have decided to not do myself. But for me personally, then, I have income from limited companies. I have income from a sole tradership company that I have as well. And then I have income from personally held properties. And then, of course, because you're filling in your self-assessment, you've got little bits of income as well. So interest on savings or interest on angel loans, for example, that all needs to go in. Perhaps you've made a profit from shares, that needs to go into a self-assessment. If you've given money to charity, you can include your gift aid details on there, which will help reduce things. If you're part of a couple with children and you're receiving child benefit payments, then that needs to go in there, because depending on how much you earn, it can change your tax. So there are lots of different bits that you need to go into a tax return. And I quite like going through the tax return and saying, oh, yes, that applies. No, that doesn't apply. Oh, hang on, let me just spend 10 minutes reading this description to work out whether this applies or not. But at least then I know. I know that I have actually thought about all the different bits that apply for a personal tax return.
I just want to highlight the words you've just said there. I like going through the tax return. And I'm just underscoring that for both ourselves and the listener, because I'm putting myself out on a limb here, but listener, please do reach out to us at the Biz of Property to confirm whether or not you too would enjoy going for a tax return.
Please don't send too much hate mail. Yes, perhaps that was a slight slip of the tongue, but I feel reassured by having actually gone through it and checked these things. And it does take time. It does take some reading every year, because I only do it once a year and I can't remember what half of the terms and fields and descriptions and things are. But it is reassuring. I mean, your accountant who does your self-assessment, Stuart, they ask you to fill in a spreadsheet for your properties. But how do they get all these other bits of information? How do they get your dividend records, for example, from your limited company? Do you have to send them copies of your I can't remember what the word is, but you get a piece of paper effectively, but obviously probably in digital form these days, when you get paid a dividend. So is it that? And how do they handle sort of other bits like interest from your savings accounts?
Yeah, well, I mean, it's in terms of dividends and things, they create that. So the accountant
so you're using the same accountant for your limited company and your self-assessment.
Yeah.
That's cheating.
Yeah. For me, it wouldn't make sense. So, and that's pretty much, goes back to, my first point is that for me, I want that consistency, and I want to, and essentially ensure that the accountant is taking that responsibility as well. So if they are dealing with all of our accounts, which they are, so they're dealing with both mine, my wife's, property, and so on, that actually they have all the information that they need. And if only I had savings that were generating income, Simon, I could answer that question. But
you will be. I mean, even if you've got just a few pounds in the bank over a year, well, maybe not a few pounds, but maybe 1,000 or 2,000, you'll get a few pence of interest if it's in a savings account.
I'll refer
strictly speaking, that should be declared.
I refer the honourable gentleman to my previous point, which is that is not a challenge in our current predicament. So there is more money out than comes in for us. So there is no such thing as interest. However, of course, with shares and stuff like that, when at the end of the tax year, should that happen, well, when it happens, we'll obviously declare what needs to be declared.
Yeah, although I think in shares, you went for a Vanguard ISA, didn't you?
Yes.
Certainly I did.
Yeah.
So actually you don't have to declare those because they're in that tax-free wrapper.
The only other thing I was thinking, and it's funny, I was reading about this the other day, was that the HMRC even say that even if you're employed as a PAYE, if you earn over 100,000, that you should still, I think they word it as still consider, but you should still potentially do a self-assessment tax return. Don't ask me why, I can't remember that element, but that was just interesting to show that, the tax people, I think we should call them now, because I'm sure the tax women are as as aggressive in chasing down tax as the men.
I did wonder where you were going to go there.
The final question I've got for you before we wrap up today was just, I suppose for me, we could get into a lot more detail on this, but we don't have the time today. But in terms of the time it takes you, given that you've been doing it for 20 years, like how much time does it take you to complete this on an annual basis?
So I've got relatively used to the kind of information I need. So, for example, whenever I make a charitable gift, I will save a copy of that receipt into my tax folder for that year so that I have a record of it. So I know that it's going to be there when I'm collecting to go to the gift aid. I know where I need to go now to download statements for interest payments. I have PATMA, of course, which allows me to collect together all of my property details and property finances. And I do that monthly. So I update that up every month, keep those records nice and up to date. So at the end of the tax year, all I have to do is press a button to give me those figures. So to actually bring all of this together into a tax return, which I should really, really do before January. But anyway, we'll park that for the moment. It generally takes A day, I would say, maybe a bit less. So this weekend, I did it in a number of sittings over the weekend, but I think the total was about a working day. And it's not 100% finished. I've got a couple of things I just need to double check. So by the time I've totally finished it, maybe it'll be a day and a half. So it's not masses of work. Of course, keeping the records throughout the year has taken a little bit of extra work. But I mean, in case of the property, for example, you have to do that work anyway, putting together your spreadsheet. So you're still doing work. So how long does it take you to prepare stuff for your accountant?
Well, for the only thing I really prepare, I would say the personal tax returns on the properties, and I would say never more than 2 hours, because it's fairly straightforward, and because I've done the spreadsheet once, essentially it just captures all of the costs. So obviously your rental revenues, and then your ongoing costs in terms of agent fees, and then, to be honest, the time taken is just to grab any of the invoices for costs associated to those properties, which, as they come, they just get put into the year's tax folder, and so they're all there. So typically, it's all done. It's still a bane for me for that 2 hours. I still detest doing it. And just your day and a half, does that include the submission itself?
Yes. So that's collecting together the figures, putting a few of them into some temporary spreadsheets to just do bits of extra stuff here and there, and actually logging into the website, going through the HMRC form, selecting what's included, what's not included, rereading bits and pieces that I've forgotten, checking all of that, putting in all the figures, going through the calculations, which the website does for you, and then sort of double checking them and getting a copy of the sort of finished form, which I will then reread and make sure that there doesn't seem to be anything wrong. I will actually also these days compare it side by side to my form from the previous year, just to make sure that nothing seems particularly out of place or different from the last year that might seem odd. And yes, all of that will take something in the region of a day and a half this particular year. And in actual fact, this particular year is slightly harder than normal because I've had a capital gain as well. As we've spoken about previously, I sold a property a little while ago, and there was a capital gain to be had there. And it had to be declared within 30 days of the property sale and the tax paid. And that's sort of all handled and done. But then in your self-assessment at the end of the year, you have to declare it again. And that actually took me quite a while to read up on and work out how that needed to be included and what details needed to be included there, and referencing back to the previous submission and tax payment of the capital gains tax in the at the point of sale. So yeah, a day and a half this year. Perhaps without the capital gains tax complications, perhaps it would be a bit quicker in previous years. I can't actually remember.
So we've got two camps here. There might be a third that we're unaware of, but depending on your camp, do feel free to tweet us at bizofproperty. That's BIZ of property on Twitter, and let us know which camp you're in. Would you rather free up your time and do it yourself, or do it yourself, and for what reasons? And Simon and I have both given ours. Be really interested to hear yours and why you decided to go your route. So please do join the conversation at Twitter.
Yeah, please do. I look forward to hearing from you, as long as it's not hate mail about the fact that I like looking through my tax return every year. Maybe it could be some consolation mail or some I don't know. Anyway, please do get in touch, and please do also let a friend or two know about this podcast and how much you enjoy listening to it. We will very much appreciate it. Show notes, as ever, can be found at thebusinessofproperty.com. And Stuart and I will talk to you again next week.